Jyoti Jaipuria is here with us to talk more about areas of the market and how he's approaching. Jyoti, when we spoke last, you were relatively cautious. In
Yeah.
fact, today Kotak has come out with yet another note saying, in the recent time, this is the second one, the cautionary kind of a note, saying that it's all greed out there. There is no fear at all. Do you concur with their view? Is it all greed out there? No fear
Uh,
at all?
yeah, so Ajay, what's happening is obviously the valuations are not cheap. And if we go back into history, buying markets at 20 times 1 year forward has not really led to any meaningful return over the next 1 2 years. So to that extent, all of us are very cautious on the valuations, what it is. The good thing, of course, is though the valuations are expensive, the fundamentals still continue to be good. The result season just ended, and I would say the result season produced earnings which was slightly better than what one would have thought at the beginning of the season. I think most consensus were expecting earnings growth of 12-13%, and we have ended up with north of 15, I think closer to 17% earnings growth. So the fundamentals continue to be good, but at the same time, valuations are not cheap. So for us, it is, it's probably a time and price correction required to bring valuations back to normal. So far, it's not looking like we're getting a price correction, but hopefully then we'll get a time correction, which makes it a little more elongated and range bound sort of market.
Okay. Jyoti, does it also mean that you have trimmed some exposure where you have made some major money? Or it's that you're not buying new, you're staying put with your current position, but you're not buying afresh?
So, on the margin, I would say our cash is higher than what it was at the beginning of the calendar year. So, in some sense, we've increased our cash position, I would say, by around 200 basis point relative to where we were on Jan 1. And for us, it is, slowly, building up some cash. So, there's a war chest in case the market's correct and, some of the stock prices become very appealing, then it helps us to buy at those levels.
Okay. Insurance stocks, especially PSU insurance stocks, have climbed very smartly. It was the under-owned and unloved area of the market. Do you see merit in any of them? Do you have exposure or you missed it too?
No, so we've not had exposures. Like, generally we try to take calls which are more, we don't churn our portfolio too much. Our churn ratio is very low. So for us, it was, banking is the space and, financials which are related to the stock market. Those are the space we've been playing with. So we've not really bought insurance for the last 3 years.
Okay, fair point. How about two-wheeler? Today, the way TVS Motors and Bajaj are running away, are they discovering something new? Is it new launches? What exactly is triggering this re-rating as far as two-wheeler stocks are concerned?
Yeah, so if you see the whole auto segment, the two-wheelers were initially the laggards in the segment, and the cars and the CVs were doing better. So the two-wheelers are playing a catch-up. So again, we are a little contrarian in some of this. So for us, we are actually trimming autos. For us, we've seen the best of autos over the last 18 months, and I think the next 12, 18 months will not be a great period for the auto majors. There's some, ancillaries which we still like, but I think what we'll start seeing over the course of this year is that month on month and year on year sales numbers will start to look, much more muted because, the base is catching up.
Interesting. There are some very beaten down, auto ancillary names, Jyoti. Today, in fact, we were speaking to this company called Minda, and the sense we got that they are bracing in for big demand going forward, buying new parcels of land, expanding capacities. Do you have any exposure in any of the auto ancillary names, and what is your sense on this space?
Yeah, so like I said, we still own some auto ancillary names. And, I would break this auto ancillary to two parts. One is people who cater only to the domestic and people who cater to domestic plus international. So what happened in the last 18 months is people who are catering to international players, which was, exports. That part has been under pressure because of a slowdown in demand. And, those companies have got hit. The people who are catering to the domestic only, they have done very well and, they continue to do well. So for us now, we continue to hold a lot of these people who are more exposed to the domestic market. But some of these names which cater to international are starting to look attractive. because they've become cheap, they've underperformed for quite a long time. And for us, it just gets down to, okay, at this stage, what is the margin for making a lot of money? And it's probably starting to surface here.
Jyoti, one is getting a sense that in the new environment, deposits may continue to remain bit of a challenge, while credit growth itself is slightly sombering. But when we speak to some of the SME-oriented lenders like Ugro or Poonawalla or some small finance banks, they appear to be pretty comfortable on growth still 30-35% because of the SME nature of their book. You find it risky or you find opportunity here among lenders?
So there is opportunity among the lenders, and we are playing a mix of NBFCs and the banks. From our point of view, if we look at the way the market is positioned today, actually the banks are standing out as one of the relatively more cheaper or relatively less expensive place, because it's not like nothing very cheap in the market today. But the banks are start looking good. Last few quarters we've seen like disappointment in terms of NIMs, which we were expecting to happen because it's a very cyclical play. So to some extent, a lot of that disappointment is starting to get baked in the price. There are some lenders which are trading at very attractive price to books of less than one time, and that is where really we've been focusing on.
Okay. Just out of curiosity, Jyoti, I want to understand how's the earnings growth now that the entire earnings picture is out and the quarter has gone by. How's the earnings growth looking for your portfolio right now versus the valuation it is at?
So we of course run two portfolios. So one is a largely small and mid cap portfolio. So that part, the earnings growth has been really robust, and we've done earnings growth of close to like 30% plus for that whole pack. Uh, in general, if we see for the Nifty companies, also the earnings growth for this quarter was 17%. We'll probably end the fiscal year with earnings growth of close to 25%. Now, if you just look at this breakup, the first half was earnings growth of over 30%. So to that extent, the second half is going to see a slowdown. But 25% is going to be really healthy, because if you think of, let's say, US or something, earnings growth is going to be like close to 0%. It's going to be low single digit earnings growth. So India like really standing out in terms of earnings growth as well as economic growth today.
What's your take on pharma? Are you in pharma today? What happened was that some great commentary from Natco or even Glenmark sparked big rallies in these two names. What is your own take on pharma? Do you like any of these names or any other which you have bought into?
So, we like pharma a lot. So, like I think probably told you on one of these earlier shows that we got quite positive on the US generic pharma, because our view was that the price erosion we've seen for the last 5, 6 years is starting to bottom out. The price erosions are going to be much more lower than what we've seen in the past. And so we bought a couple of names which cater to the US generic market. And that's one space which, had been underowned for quite a long time. The stocks had underperformed. And that is where, a lot of money can be made. Even the other spaces, like we own a CRAM company in India, which again is a very exciting space, and I think it will do very well. We've reduced our exposure to the domestic pharma. So domestic pharma is something we had played for the last couple of years, but that we sold and we moved to more US generic facing pharma. So in pharma, there are many segments actually, obviously, and each company has its own growth part. But in general, I would say the US generic space is something which will be exciting over the next 12, 18 months.
Interesting. Before we let you go, a quick view on the PSU pack. The opinion is pretty divided right now. Some say that there is a structural re-rating which is underway, and even this after the rally which we have seen in PSUs, there is room for more. Others believe it's a bubble in making, should be avoided. Which part of the argument are you, Jyoti, from?
Yeah, Ajay, what we look at is we don't look at PSUs as one basket, but we tend to look at within each segment, because each of these they are catering to a whole lot of segments. So within PSU banks, we look at PSU banks versus private sector banks, and we buy whatever seems more compelling in terms of valuation. I would say somewhere in some of these defense and railway stocks, valuations have probably run ahead of themselves, and that is where you could see some, price correction. But some of the other PSU banks are probably PSU spaces are still okay. It's like, I think oil and gas is one area we've not seen any meaningful share price increase. So that is something which could get interesting in the PSU bank. So I would say think of it more as each sector rather than think of it as a PSU in general.
Excellent. All right, Jyoti, we'll let you go on that one. Thanks so much for your time this afternoon.
I
That was Jyoti Jaipuria, market veteran. Before we take a break,